Welcome to the Wednesday edition of the Tech Stocks Daily Podcast. Today we're diving deep into the heart of Nasdaq's tech giants, capturing their latest maneuvers and milestones. From Google's strategic dance around third-party cookie phase-out, to Microsoft's significant AI and cloud bets, Spotify's impressive earnings symphony, to HashiCorp's game-changing acquisition by IBM, we've got all the insider info. Plus, we unravel the complex tapestry of market sentiment wielding cautious optimism, innovation, and regulatory challenges. Get ready for a roller coaster ride through the dynamic world of tech stocks, where cautious optimism meets strategic gambits in AI, cloud infrastructure, and beyond. Buckle up, it's going to be an engaging and insightful journey. Today, Google finds itself at the center of an electrifying buzz in the tech world for several pivotal developments, each sketching a vivid picture of the vast, often unseen forces shaping the internet's future and highlighting Google's monumental role within it. The tech giant, known for setting the course of digital evolution, has once more underscored its influence across various sectors, from advertising landscapes to education technology, and its strategic maneuvers in the AI arms race. Firstly, Google's decision to delay phasing out third-party cookies in Chrome until 2025 has sent ripples through the online advertising industry. Initially slated for a much earlier execution, this reversal isn't a first, marking the third deferral. This move highlights a deep-rooted struggle within the digital ad ecosystem, struggling to adapt to a future without cookies. Small bits of data critical for ad targeting and performance analysis. Google's dominance is not just a testament to its market share in online advertising, where it owns essential infrastructures on both buying and selling sides, but also to its sprawling digital empire, including platforms like YouTube, Android, and Gmail, which house vast troves of user data. This juggernaut's influence is so profound that regulatory bodies worldwide, including the US Department of Justice and the European Commission, have cast scrutinous eyes over its practices, fearing anti-competitive behaviors. Diving into the partnership realms, Google Cloud has allied with Magic EdTech, marking a significant stride towards AI-enabled education. This partnership epitomizes the tech titan's venture into leveraging cloud infrastructure for transforming educational content delivery and personalization through AI, promising a new era of digital learning. Another facet of today's buzz is the aftermath of Google's third-party cookie phase-out delay, which serendipitously buoyed stocks for Trade Desk, a digital advertising rival, while leaving Google's market position largely unshaken. This scenario not only sketches an intricate picture of ad tech dynamics, but also reveals the broader industry's pulse amid evolving privacy norms. Amidst the competitive ferment, Google CEO Sundar Pichai's candid remarks about being caught off guard by the generative AI boom adds a layer of introspection to Google's innovation journey. Despite a storied history of AI research and development, including famed projects like Google Brain and DeepMind, Pichai's acknowledgement reflects a tech titan grappling with shifts in technology's tectonic plates, mobilizing to recalibrate its course in the AI race. A narrative enriched by Google's rough encounters in launching AI-fueled products like Bard and Gemini. Lastly, an existential tremor beneath Google's foundations comes from within, as its search chief alerts of tougher times ahead. The era's shifting sands, underpinned by a rising AI-driven search engines like Perplexity AI, signal an inflection point for Google, a beacon of search for over 2 decades, now faced with the imperative of innovation to maintain its stronghold. In today's swirl of events, Google embodies the quintessential tech titan at a crossroads, juggling regulatory scrutiny, competitive pressures, and the relentless march of innovation, all while holding a lantern to the pathways of digital tomorrow. Today's buzz in the tech universe has Microsoft taking center stage for more reasons than one. Keeping pace with its innovative trajectory, Microsoft finds itself under the spotlight, primarily due to its financial moves and burgeoning stakes in the artificial intelligence sector. Let's unpack why Microsoft's name was on everyone's lips today. First off, Microsoft's impending third-quarter earnings report has investors and tech enthusiasts on the edge of their seats. Scheduled for release after the market closes on April 25, 2024, there's widespread speculation about the potential impact on Microsoft's position in the tech sector and the broader market. Despite facing a significant tech sell-off recently, Microsoft has displayed resilience with a modest 0.6% increase over the past 3 months. Analysts predict that an earnings beat might further catalyze its market performance. Given its historical penchant for surpassing earnings expectations, all eyes are on Microsoft for its upcoming financial disclosures. On another front, Microsoft's ambitious forays into artificial intelligence are shaping up to be a game-changer. The company's financial embrace of AI innovation shines through its recent commitment of $1.1 billion in a strategic partnership with Coca-Cola. This collaboration aims to harness the capabilities of generative AI and cloud technologies to revolutionize various business functionalities. Through Microsoft's Azure OpenAI service, the partnership is set to explore groundbreaking AI use cases to enhance customer experiences, operational efficiency, and more. This move not only exemplifies Microsoft's leadership in merging AI with business solutions, but also underscores a larger trend towards AI-led corporate innovation. But Microsoft's AI ambitions don't stop there. The tech giant is also making headlines due to scrutiny from British antitrust regulators over its partnerships in the AI domain. The UK's Competition and Markets Authority is inviting comments on Microsoft's affiliations with generative AI model creators and its hiring spree of key industry talents. The focus is on whether these endeavors constitute mergers, which could impact competition within the bustling AI landscape. With Microsoft disputing the merger narrative and pledging full cooperation with the CMA, this investigation highlights the regulatory challenges facing tech behemoths as they push the boundaries of AI advancements. In essence, Microsoft's news today paints a picture of a tech titan at a crossroads of financial scrutiny and forward-looking AI explorations. As it gears up to reveal its quarterly financial health, its strategic investments and partnerships reflect a robust commitment to shaping the future of AI in the business world. Meanwhile, regulatory watchdogs are keeping a close eye, ensuring that the path to innovation remains competitive and diverse. It's clear that Microsoft's journey is emblematic of the broader dynamics at play in the tech industry, where financial performance, innovation, and regulatory oversight intersect in unpredictable and exciting ways. Buckle up, tech enthusiasts, because today's hot topic is Spotify's latest financial symphony, striking all the right notes in its first quarter 2024 earnings report. The music streaming giant not only beat expectations with a total revenue jump of 20% year-on-year to a harmonious $3.95 billion, but it's also hitting a high note with an EPS of 105, cruising past the anticipated 70 cents. Now, let's break down this earnings concerto piece by piece. First up, Spotify's premium segment orchestrated a robust performance, contributing to this revenue crescendo with a 20% growth, reaching 3.25 billion euros. This was powered by a blend of new subscriber additions and sweet increases in average revenue per user. Despite a slight miss in the monthly active users forecast, growing by 19% to hit 615 million, the platform's ad-supported MAUs tuned up a 22% increase to 388 million, with premium subscribers growing by 14% to 239 million. On the financial scale, Spotify's wallet is well-tempoed with 4.7 billion euros in cash and equivalents, and it generated an impressive 207 million euro in free cash flow. Looking ahead, the company is tuning its projections to expect second quarter revenue of 3.8 billion euros and eyeing MAUs to expand to 631 million. The symphony of optimism doesn't stop there. Analysts have sparked a flurry of acclaim and upward price target revisions following these revelations, a clear indicator of their confidence in Spotify's growth composition moving forward. In another major chord, CEO Daniel Ek addressed the stark realities and challenges following a massive layoff of 1,500 people in December, a decision which, while strategically sound, dissonanted Spotify's day-to-day operations more than anticipated. Nonetheless, the swift recovery and beneficial outcomes of this strategic reset have put Spotify back on track, underscoring a strong recovery narrative as it bounces back to profitability with a quarterly profit of 197 million euros, a lofty leap from the previous year's loss. Adding more to Spotify's current applause is the record-smashing reception of Taylor Swift's latest album, The Tortured Poets Department, which now holds the crown for the most streamed album in a single day on Spotify. This not only underlines Spotify's prime position in the music streaming arena, but also showcases the platform's mammoth influence on global music consumption patterns. Despite these upbeat tunes, Spotify's stock faced a downside movement, shedding over 7% in Wednesday's trading session. This paradoxical market response juxtaposes sharply with the positive outlook shared by analysts from JP Morgan, Piper Sandler, and Goldman Sachs, who, enchanted by Spotify's robust financial health and progressive outlook, have upped their price targets. In essence, Spotify is playing a sophisticated melody of financial growth, strategic alignments, and market leadership. Even with the stock's temporary decrescendo, the long-term composition spells a crescendo of success and innovation. As it continues to evolve its content ecosystem and capitalizes on its core strengths, Spotify solidifies its standing as a maestro in the global audio streaming concourse. Tech enthusiasts and software savants, today's vibe in the virtual cloud corridors was undeniably thunderous, with the buzz about none other than HashiCorp, a company that's been radiant on our radars, and rightfully so. HashiCorp, a pivotal player in the open-source software domain, notably recognized for its innovations in cloud infrastructure management, made headline after headline in the NASDAQ orchestration due to IBM's latest strategic maneuver. In a bold and banking move, IBM disclosed its intent to acquire HashiCorp in a staggering $6.4 billion cash deal. This decision comes amidst IBM spotting another quarter of revenue slip, where instead of dwelling in dismay, it strategically placed its chess pieces to fortify its positioning in the cloud arena. The acquisition's finances break down to a hefty $35 per share, a tactical move on IBM's part, following the swirling rumors and reports that jet-propelled HashiCorp's shares in the trading stratosphere. IBM's attraction to HashiCorp isn't just a sudden impulse. It's a well-contemplated strategy to bolster its hybrid cloud sector, dovetailing perfectly with its 2019 acquisition, Red Hat. Both Red Hat and HashiCorp herald the era of open-source software's quintessential role in cloud infrastructure, making this move look like a matrimonial match to augment IBM's cloud prowess. HashiCorp, though competing in a revenue race with IBM, has shown promising growth and a potential that IBM envisions to leverage, especially to enrich its Red Hat offerings. But why is this chess move by IBM causing such a stir? it's the implications, tech fam. Through this acquisition, IBM is planting its flag deeper into the hybrid cloud battlefield, aiming to enhance its service spectrum by integrating HashiCorp's revered tools like Terraform. This is not just an acquisition, it's an evolution, a strategic shift under CEO Arvind Krishna's vision of steering IBM towards becoming a hybrid cloud and artificial intelligence titan. HashiCorp's journey, despite its consistent growth, has been a roller coaster of revenue variances and speculative trading. Yet, amidst the fluctuating fortunes, this acquisition has piqued the interest of investors, analysts, and tech enthusiasts, leading to a frenetic feast of forecasts and financial fables. As the shares danced in response to the news, questions buzz around the net worth, timing, and the trajectory of this tech titan tandem. So techies, cloud curators, and software savants, what are your thoughts on this monumental move by IBM? Do you foresee this merger as the dawn of a new era in cloud computing, or is it a desperate gambit in the face of financial flux? HashiCorp's leap into IBM's embrace, is it a path to unprecedented growth, or a place safe in the unpredictable tides of tech? I'm all ears and can't wait to see your analysis, predictions, and viewpoints flooding the comments. Let's dissect, discuss, and dive deep into this digital drama. The floor is yours, folks. The overall market sentiment today appears to be a complex tapestry of cautious optimism, marked by strategic gambits in the tech sector and underscored by a keen focus on future technologies and innovation. On one hand, there's a palpable buzz around companies making significant moves towards capitalizing on AI and cloud infrastructure, which suggests a strong belief in these domains as pivotal growth engines. On the other hand, regulatory scrutiny and operational challenges present a counterbalance, injecting a measure of caution into the mix. Google's story today paints a portrait of a behemoth at a crossroads, deftly navigating the dual pressures of innovation and regulation. The delay in phasing out third-party cookies suggests a strategic move to stay in tune with the digital ad industry's readiness, while cementing its dominance in online advertising, albeit under the watchful eyes of regulators worldwide. This move, along with ventures into AI-enabled education and strategic responses to shifts in the AI landscape, indicates a forward-looking posture, albeit one tempered by external pressures and the need for adaptation. Microsoft's narrative rings with anticipation, bound up in its upcoming earnings report and its evident deep dive into AI, showcased by significant investments and partnerships aimed at integrating AI into business solutions. The tech titan's approach, underscored by a robust commitment to leveraging AI while navigating regulatory landscapes, mirrors a tactically optimistic outlook on leveraging innovation for growth, even as it faces potential challenges from regulatory bodies. Spotify's performance, with its impressive earnings beat and strategic adaptations, sings a tune of resilience and recovery, heavily banking on content and market leadership to propel growth. However, the market's paradoxical response, with a slide in stock value, introduces a note of caution into the otherwise optimistic narrative of the company's journey. HashiCorp's saga, culminating in the acquisition by IBM, highlights a strategic alignment within the tech industry towards bolstering cloud infrastructure capabilities. This move not only reflects IBM's aggressive posture towards strengthening its hybrid cloud and AI services, but also imparts a bullish sentiment on the value of integrating open-source software for enhanced cloud offerings. In essence, the day's news from the tech sector conveys a sentiment of strategic optimism, with major players actively positioning themselves for future growth through significant investments, partnerships, and innovations, especially in AI and cloud infrastructure. This forward momentum, however, is carefully calibrated with an awareness of the regulatory and operational hurdles that loom on the horizon. The tech industry, by all accounts, appears geared towards navigating the twin demands of innovating for the future while managing the complexities of today's regulatory and competitive landscape. All right, folks, today we're zoning in on Google. Given the latest whirlwind of developments, the critical question is, should you swipe right on Google by buying, hold hands, or swipe left by selling? My take on this is a cautious but optimistic hold, and here's the lowdown on why. Google is navigating a Titanic-sized iceberg field, with key highlights being its strategic delay in phasing out third-party cookies, its leap into AI-enhanced education with Magic EdTech, unfazed market position despite ad tech dynamics, and internal confessions of being overtaken by the generative AI wave. The delay in cookie deprecation shows Google's tactical flexibility, acknowledging the ad industry's slow adaptability, which in turn secures its dominance in online advertising for a longer stretch. This maneuver could be seen as maintaining status quo, but is sincerely a chess move in preserving its ad revenue fortress while the industry grapples with privacy-centric advertising models. The strategic DAP with Magic EdTech thrusts Google into the spotlight of AI-driven educational transformations, signaling its ambition to spread its tendrils into new, fertile grounds of cloud and AI applications. This diversification hints at a broader vision beyond its traditional search and ad empire, suggesting potential growth avenues as education technology soars. However, it's not all sunshine and rainbows. The revelation by CEO Sundar Pichai about being caught off guard by generative AI's boom flags a note of concern, indicating possible chinks in Google's innovation armor. While it has had a storied presence in AI research, its seemingly slow pivot towards leveraging newer AI paradigms could be a hiccup in its otherwise smooth march forward. Moreover, the hint from Google's search chief about tougher times ahead amidst the AI-driven evolution of search technologies puts the giant at a peculiar inflection point. With competitors like Perplexity AI entering the fray, Google's decades-long unchallenged reign in search faces potential threats which could impact long-term growth. Despite these challenges, Google's response to competitive pressures and regulatory scrutiny, combined with its persistent innovation drive and financial muscle, suggests resilience and potential for growth. There's more than a sliver of opportunity for Google to redefine its strategies and maintain its stronghold in its diverse business segments. Given its historical knack for navigating regulatory jungles and market transformations, holding GOOG stocks might be akin to staying aboard a ship that's navigating stormy waters with an experienced captain at the helm. If Google fits your investment thesis and risk appetite, you might just have found an interesting hold in your portfolio. Keep those signals coming, folks, and let's decode the digital era together. One trend, one bite at a time. Today's market activity served up a dynamic platter of technological advancements, strategic shifts, and financial revelations. From Google's strategic pivot in ad technologies and Microsoft's bullish bet on AI, to Spotify's strong financial performance and HashiCorp's significant acquisition by IBM, the tech landscape is clearly bustling with energy, innovation, and change. These developments not only underline the industry giants' aggressive maneuvers to corner growth niches, but also highlight the underlying trends shaping the future of tech. Think AI, cloud, and digital transformation. Amidst this flux, the tech industry's pulse today was one of cautious optimism, driven by a forward-looking strategy bedecked with both opportunities and challenges, underscoring the never-ending cycle of disruption and adaptation that defines this domain. Thanks for watching to the end. Remember, this is just one story from our full daily show, which includes all the other news and an analysis of the day's tech market activity. If you found this video interesting or insightful, then please like, subscribe, and share it with others. Your support is greatly appreciated. Catch you later.